Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. So, how do our panelists read the latest third quarter GDP number? And how do they think that number will affect the stock market going forward? That's what we'll find out from our editor-at-large, Steve Reitmeister, research director, Shiraz Mian, and top market technician, Kevin Matris, on this edition of the Roundtable. So it's again an interesting set of circumstances here. We've got a 3% growth number, headline number that was reported with third quarter GDP. Last week we're having this discussion on the 2nd of November here. Are we to assume then, as that number might indicate, Shiraz, that the recession actually ended in the third quarter?
Yes, unofficially so. It was a very important number in the sense that the market's growth and rise from March onwards needed to be proved in terms of the earnings expectations that were built into the prices and also the underlying economy. So it came in positive. Right. So it broke the cycle of the negative growth numbers that we had been seeing consistently over the preceding quarters. And then it came in better than expected. Now, folks started questioning the quality of those numbers, right, saying that this was entirely fiscal stimulus driven. And the funny thing about that is that going into those quarterly earnings numbers, everybody knew that the underlying economy, the private sector driven economy, was essentially on deathbed. So it was all the growth was supposed to come from the government side, and this is what the Keynesian economic system would give you. It's the key critical issue going forward for the market and for the economy would be how good the private sector and the rest of the economy can take on the lead given by the government stimulus and create and give us a self-sustaining economic growth going forward. We need to see signs that investment from the private sector are coming up. We need to see some stability in the labor market. We need to see some signs of stability on the consumer side. We haven't seen that yet. There are some signs. Today's ISM numbers were very good, and the housing picture seems less ugly than it has been in the past. So it's a mixed picture on the economy front. But having the positive, better than expected economic growth for third quarter was a major positive milestone for the market and the economy.
Kevin, what do you think? Is the economy fixed yet? Or just on the mend?
Yeah, I don't know if it's fixed yet, but the 3.5% GDP, that was an impressive number. It was way above the consensus of 3% and way above the 11th hour downgrade by Goldman, which was 2.7%. And again, the market did react very bullishly, but I believe as analysts really started to look at the numbers, I believe they decided that it wasn't really as good as the headline number had suggested. Building on what Shiraz had said, I believe 1.66 points was attributed to the Cash for Clunkers program. Mm-hmm. You take that out, and your GDP is now below the 2%. Another thing, too, that some analysts were looking at is they were talking about inventory rebuilding. Now, this is where I disagree with some of the analysts. Inventory rebuilding is usually considered to be some of the lowest quality growth, but with inventory stripped down to such historically low levels, I believe that inventory rebuilding, assuming sales warrant, I think that is going to continue to add to economic growth for many, many quarters. But again, that is the big if in fact sales warrant it. But the one thing everybody should keep in front of them is that if you look at real GDP growth on a year-over-year basis, you're still coming in at minus 2.3%. And I do worry that what's going to happen to our GDP once all of this stimulus money is taken away, and I fear that Q4 may start getting lowered as we move forward in time.
All right, how are you reading it? Should the investors be happy with that number?
Well, take a look at what the investors did. At first, there was the cheer, and then there was the overnight. Let's take a look at what's really behind these numbers. So, after the party was over, then they're cleaning up the room and, and throwing out all the garbage. Like, maybe this wasn't as good as I thought it was, and that's where you see you saw all the profits from Thursday taken back on Friday, and even a notch more. So, we are locked in this struggle of, okay, we are not falling off the cliff anymore, but how can we go higher without some belief that the economy is repaired on its own? So in other words, it's okay. I use the analogy of the jumper cables, the government giving that jolt of stimulus to our economic car battery, right?
Right.
But the thing is, will our car start again on its own? And that's the great debate that is going on right now, because when we take a look at that GDP report, we strip away the government stimulus, not too much going on. So where will we be a couple quarters down the road? That is a great debate that is taking place, and that's why the market just keeps fighting over the same couple hundred points over and over again. And I think we're going to be here for a while.
So going forward here now into the end of the year, as far as the market's concerned, what do you think the market's going to be doing here? Don't forget we have end of the year window dressing too.
Yeah, well, and the window dressing just shifts money into some winning groups and out of other groups, but really creates no net positive, for the overall market. Just people shifting things around so they can say, hey, look, in my portfolio I had some of the best stuff. The mutual fund managers can play that game. Mm-hmm. I'm going to stay with what I said last week, which is that my year-end prediction is about 10,000. I think we're going to be stuck here in a trading range for a while. Which, hey, every day above 6,500 is a good day in That's reality. Right. So the primary trend, okay, taking a look over the long haul, is positive until proven otherwise. The secondary trend, or the intermediate trend, is a trading range. Okay, so we've made up a lot of ground, and it's not going to move higher until there is proof of a sustainable growth in the economy. Hopefully, we get it, and we continue to advance above 10,000. For now, we're just going to play in this trading range.
Shiraz, what about you? What impact does this have on the market here going forward?
I think it's positive in the sense, like I mentioned in my earlier comment, that it reaffirms the market expectation that the rise it had from spring onwards had a proper fundamental basis. So we got two very good reports in the last few weeks. Number one, we had good quarterly earnings, and now we have the GDP numbers. So we are unofficially out of the recession. And these are both very good substantive points for the market to stabilize, to build on the gains that it has had up till now. How does it move from here onwards? We need some proof. The market needs some proof that the economic growth is sustainable. Yes, the 2.5%, 3% growth can be driven by the fiscal stimulus up to the middle, maybe even up to the third quarter of next year. Mm-hmm. What beyond? Can the private sector come in and take the baton and run with it? And that's the critical question. In each data point that the market sees, we will see its response with it. So if we see any change in the Fed's language, for example, this week, that the extended period comment that they had been putting in the statement for a long time, if there is any tweaking to those words, we would see a response from the market. Each economic data point that we see going forward will show a response. But on the whole, I'll agree with Steve's comment that we'll stick around a narrow range. But the downside fear issue, in our view, has been removed, both by the third quarter earnings releases as well as the GDP numbers.
Interesting. We're going to pass the baton over to Kevin on this question. Are the technicals saying anything different from what we've been hearing here?
They're not saying anything different, but getting to the question that you had posed to Shiraz, what does the GDP do to the market moving forward? And I believe that the answer is to be determined. The market and the economy indeed is in better shape now than where we were last year. But I got to tell you, even though earnings season was good, the market's reaction has been very disappointing. And the GDP number, as spectacular as it was in and of itself, it hasn't really been able to give any kind of real sustainable lift to the market. And, I think people are already past Q3 and they're now looking at Q4. And as I said earlier, I think people are worried that Q4 is probably going to be, estimates may be lowered as we move forward. Don't get me wrong, I still believe that there's plenty of opportunity in the market, but it's not going to be as easy as just buying anything like a couple of months ago and everything just goes straight up. I think there's going to be clear winners. I think there's going to be clear losers. So you just have to kind of know where to look. But if the market can pull itself together in this area, I still think there is a chance to challenge 10.8. But if it can't, we could be in for a little bit more pain. It just feels as if the market all of a sudden has gotten a little bit heavier.
All right. Well, I know I'm clear on the whole thing. Hopefully that helps you out as well. With everybody here at the roundtable, I'm Terry Ruffalo.